Well, hello everyone. In this particular presentation, we're going to discuss our homework for proprietary funds. Well, proprietary funds are basically those funds where we account for the government's quote-unquote business type activities. And so with business type activities, we need to understand that our customers are either external from the government or internal, basically the other government departments. When our primary customer are the internal customers, we use what's known as an internal service fund to account for the transactions. And this is when one government department services other government departments. We have an example here where we have a city. They created an IT department 4 years ago to centralize IT functions for the city. So basically, is this one department, the IT department, and they service all the other departments. The goal of the department was to reduce costs, avoid duplication of efforts, and provide up-to-date technology to all the city's operations. This is the reason why an internal service fund would be created, really to reduce costs and have all the efficiencies of one department doing all of the expertise, in this case, IT. All right, the fund should be self-supporting. So basically what this IT department does is it charges fees to all of the other government departments. They charge fees to cover their costs. There really shouldn't be a profit. It should be more or less within 5%. The excess of fees over expenses should be less than 5%. And here is the pre-closing trial balance of the prior year. And during the current year, we have new transactions. Now let's go through these transactions. And the good thing is that proprietary funds use accrual accounting. There is no modified accrual accounting here. So what we're going to see is some very familiar transactions you have learned in all your previous accounting classes. So we should be able to go through something like this pretty simply. Number one, gross employee wages for the year were $57,600. That includes the employer's share of $4,100 for Social Security taxes. Federal income and Social Security taxes withheld are $18,725. So we can see the journal entry here. The $57,600 is broken up into two expenses, the wage expense, and of course the employer's share of Social Security is the payroll tax expense. The amount due to the government is really the amount of the employer and employee share of Social Security plus the employee's income tax, federal income tax. That amounts to $22,825. The difference is going to be credited to cash, which is basically the payday. Number two, office expenses of $3,700 were paid in cash. Debit office expense, credit cash. Very simple journal entry. Number three, materials and supplies purchased on account, $8,400. So we bought them on account. Debit the asset, materials and supplies. Credit accounts payable because we bought it on account. Number four, a bill totaling $14,525 was received for utilities provided by Washington City's utility fund. That's an enterprise fund. So we have the internal service fund receiving a bill from the government's enterprise fund. Regardless, that's going to be recorded as an expense, debit utility expense. And instead of crediting the generic accounts payable, because it's due to another fund, we're going to say credit due to other funds. Number five, cash paid to the federal government for payroll taxes. So we're basically paying on our amount due to the federal government. That is $23,000. So we're going to debit the liability due to federal government, and we're writing a check, so we'll credit cash. Number six, cash paid to the utility fund, $14,500. So that amount, $14,525 that we entered into in number four, we're primarily paying all of it. So we'll debit the liability due to other funds, and we'll credit cash. Number 7, accounts payable at year end totaled $2,950. So we need to do a little bit of math. The beginning accounts payable was $2,550. And what else happened? We increased accounts payable by $8,400 here in transaction 3. If you take those two numbers, the beginning number plus the $8,400, subtract out the ending payable of $2,000. What did we say it was? $2,950. You get $8,000 is the amount of the payment. So we'll debit the payable, credit cash. Number 8, materials and supplies used during the year. Since we're using accrual accounting, we have to use what's known as the consumption method. And so the expense would be recorded as we consume the materials and supplies. So we're going to debit the expense for $8,250. Cost of materials and supplies used. This is an expense account. And we will credit the asset, materials and supplies. Number 9, charges to departments. So remember, that's the whole idea of an IT fund, or an internal service fund, I should say, is to basically service the other government departments. And so we sent out invoices to the general fund and the special revenue fund for these amounts. So the journal entry is going to be debit or receivable, and instead of using the generic receivable, we will debit due from other funds, and we will credit the revenue account. We're going to call the revenue account billings to departments. But that's simply the revenue account. Don't let the fancy name of the account confuse you. And unpaid balances at the end of the year. So the general fund and special revenue fund paid the majority of what we charged them, but there were some leftover balances. So the difference between the two is what those other funds paid us. So we will increase, we will increase cash, yes, with a debit, and we will credit the receivable due from other funds, basically reducing the receivable. And number 11, depreciation for the year, $6,100. We will debit depreciation expense, credit accumulated depreciation, or you can see your textbook calls it allowance for depreciation. It's the same thing. And then the closing entry for the year. Let me show you how the closing entries work. When we are dealing with a proprietary fund, I'm going to close out our revenues with a debit. We will close out our expenses with credits. And the difference between the debits and the credits, whatever is needed to balance the journal entry, we're going to use this account called excess of cost over billings, or maybe it's excess of billings over costs. In this case, it is actually we spent more money than we earned. So we operated at a net loss. And then what we do is we take this excess of costs over billings, or billings over costs, and we're going to close that out to unrestricted net position. Remember, with proprietary funds, our equity is called net position. And we have 3 categories of net position. We have unrestricted, we have restricted, and we also have net investment in capital assets. So first we close out everything to unrestricted. And then after we close out everything to unrestricted, then we will update the other 2 categories of net position. Well, looking at these journal entries, the only transaction that affected net investment in capital assets was this last one. By depreciating the asset, what are we doing? We're actually decreasing our net book value of the fixed assets, right? Because we're increasing the allowance for depreciation. And so the net investment in capital assets has to decrease with a debit, and we will credit the unrestricted. The unrestricted net position is always the opposite side. Here is the statement of revenues, expenses, and changes in net position. This is the operating statement, and you can see that we operated at a loss of $12,075. This is obviously not something that we wanted to happen. The net position at the beginning of the year was $36,200. Subtract out the operating loss, you get Net position at the end of the year of $24,125. So when we prepare our balance sheet or our statement of net position, you can see it's a classified balance sheet. We have our current assets, then we have our fixed assets known as capital assets. And on the opposite side, we have our liabilities, and here are our two categories of net position. We have our net investment in capital assets. How did we get the $17,400? Well, the beginning number, let me come up here. It was $23,500 before the year started, and we reduced it by $6,100 because of the depreciation. And that's where you get your $17,400. Same thought process goes into the unrestricted. And proprietary funds are the only place where we are required to prepare cash flow statements as well. And the cash flow statements would be prepared using the direct method, as you see here. We have cash flows from operating activities, from customers, and then cash paid to employees, the federal government, the suppliers, and the other departments. Okay, that gives you your net cash provided by operations. There is no financing activities or investing activities or non-capital financing activities, so everything is operating activities for this particular cash flow statement. So hopefully by going through that you realize, wow, this is pretty simple, pretty straightforward. It really is. It's basic accrual accounting. Internal service fund is prepared is when one government department services the other. Now, I know I'm not getting into it right here, but I wanted to remind you that when this information gets consolidated up to the government-wide statements, typically the internal service fund goes with the governmental activities column, unless they primarily service business or enterprise funds. If they do, then it would go to the business type activities column on the government-wide statements. Now the other type of proprietary fund, the enterprise fund, they will go to the business type activities column on the government-wide statements. Okay, this is another internal service fund. It's more of the same, so just for purposes of the presentation, I'm not going to go through this, but it's almost exactly the same as to what we just went over in the prior question. Okay, this next homework problem has nothing to do with transactions, journal entries, but what it does do is this is a great homework problem in discussing how the three categories of net position roll forward from the beginning of the year to the end of the year. And so we have 7 pieces of information here. And what we're going to do is with these 7 pieces of information, we are going to utilize them in deciding what does this do to the 3 categories of net position. So number 1 are the beginning numbers. The beginning net position numbers are as follows. So we have unrestricted is, we can see it here, unrestricted 1,354,692. And so I'm going to have 3 calculations down here. So we have where is the, I don't see it in the explanation. I'm surprised it's not here, but, oh, here it is, excuse me. 1,354,692. That's the beginning balance of the unrestricted. All right, and the beginning balance of restricted, I'm highlighting it here, is 0. And the beginning balance in the net investment in capital assets, we see it there, $679,800. Okay, so that's all number 1 tells us, the beginning numbers. Now number 2 says net income for the year was $162,759. And as we just saw on the last homework problem that we went through, the net income is closed out first to the unrestricted category. That's the first thing we do. And then, after we close out net income to unrestricted, that is when we update the other two categories of net position. So that $162,759, we're going to see underneath the unrestricted category, we're going to say plus net income. That increases this unrestricted equity. Okay, next, what happens? Depreciation expense totaled $54,000. So the depreciation expense will increase the accumulated depreciation, and increasing the accumulated depreciation will decrease my net investment in capital assets. So we're going to see that underneath your net investment in capital assets. Do you all see it says minus depreciation? Once again, for your notes, there is a basic formula for net investment in capital assets, and it's basically this. It's fixed assets minus accumulated depreciation minus any outstanding debt that was entered into to buy or construct those fixed assets. Okay, number 4. A piece of equipment with a carrying value of $26,100 was sold for $25,000. Now basically we're talking about a fixed asset here. That fixed asset was sold. It had a book value of $26,100. That book value comes off the books. That is going to decrease your net investment in capital assets. So I have it highlighted here, minus the sale of equipment. Hopefully that makes sense. Number 5. I will admit number 5 is probably the more complex one in this entire particular problem. And so what we have here is bonds for $500,000 were issued to construct a concession stand at the rink. At the end of the year, the concession stand was 50% complete, and construction work in progress totaled $248,000. So we were halfway done with the construction. We have spent $248,000 up to this moment in time. Okay, so what are we saying here? We are saying that the $248,000, okay, what happened is your net investment in capital assets increased by $248,000. So you might be saying to yourself, how come I don't see it anywhere in the calculation? Because, yes, the construction in progress went up $248,000, which increases your net investment in capital assets. But guess what? Your debt, what happened? It says the bonds were $500,000. Now that we've spent $248,000 of it, that means that $248,000 is now the outstanding debt that is connected with the fixed asset. And the debt of $248,000 offsets the work in progress, the WIP of $248,000. So it nets to zero. But we have to take this one step further before we drop it. Now, the original $500,000 bond was restricted. It wasn't yet connected when we entered into it to the fixed asset. But now $248,000 of it is. So out of the $500,000, there is still $252,000 still restricted. So the restricted, even though it started with a beginning balance of 0, we're going to say add $252,000. It's restricted for construction, hasn't been spent yet, hasn't been associated yet with the fixed asset, but it's restricted for that. All right, there's a lot there, number 5. Number 6, a $15,000 principal payment was made on the lease. So remember, capital leases, in this case it's a capital lease, a payment was made on the lease. What does that mean? Think about it. That means that the liability has decreased. If the liability has decreased, that means your net investment in capital asset increases. Okay, when we pay down debt, we're increasing our equity, our investment in the fixed asset. This is very similar to saying when we buy a home with a mortgage, as we pay down the principal of the mortgage, our equity in that home increases. Same concept here. And last but not least, number 7. A new Zamboni ice resurfacing machine was purchased for $250,000. At the end of the year, a $30,000 note associated with the machine remains outstanding. Well, the Zamboni machine, resurfacing machine, is an asset. It's a capital asset. It's a fixed asset. That is going to increase my net investment in capital assets. I'll say plus new equipment. But the associated note is going to reduce it. So we'll say minus the note payable for the Zamboni. So net investment in capital assets, what happened? Let's think about this overall. It started with $679,800 and it ended with $834,700. It increased from the beginning of the year to the end of the year. It increased by $154,900. Well, if the net investment in capital assets increased $154,900, the unrestricted category is going to decrease in value. The unrestricted is the offset when we record the journal entry. And your restricted, it started the year with 0 and it ended the year with 252. So the restricted increased 252. And therefore the unrestricted is going to decrease. So we say minus the increase in the restricted of 252. So here are your ending balances. Unrestricted $1,110,000, restricted $252,000, and your net investment in capital assets $834,700. And here they are right here, totaling ending net position of $2,197,251. So making sure you understand the 3 subcategories of net position. We do this for all proprietary funds, internal service as well as enterprise funds. Okay, one more question. We are going to go through an enterprise fund. So this is a water utility fund. So the government is providing water to the customers of the community. That would be you and I who actually live in the community. We own a home or live in a home or an apartment. We have some sort of living quarters within the city. And so we are the main customers. However, the other government departments are also customers. They're just not the main customer. Here is the balance sheet as of June 30, 2019. You can see we have our current assets totaling $2,693,000. We have a restricted asset. I want you all to take a look at that, $91.93. And then, of course, we have our fixed assets. On the liability side, the reason I wanted you to see the restricted cash of $9,193, on the liability side, we have an offset. This is the customer deposit of $9,193. One other thing I wanted to show you is here in the asset section, we had this asset called accrued utility revenue of $500,000. Once again, if you recall from our studies, this represents the amount that our customers used in water, but we didn't bill them until the next year. Okay, so this is an accrual, basically. So the journal entries as follows. Using accrual accounting for the fiscal year 2020, that accrued utility revenue, one of the first journal entries of the new year is to reverse it. And so that's what we're going to do. We're going to reverse that water sale debit and we will credit the accrued utility revenue. So that goes away. That way we know when we do our billing, the first billing of the year, we're going to be able to record the full amount as revenue. Number 2, and this is it, the first billing of the year, $2,982,557. Of that amount, the majority of it is to you and I, the residents of the community, but $193,866 was billed to the general fund. The other departments used water. So the full $2,982,000 is a water sale, but we're going to break it up between due from general fund, they're both receivables, and the other one is accounts receivable. That's the receivable to you and I that live in the community. Number 3, cash in the amount of $260 was received. The cash was for interest earned, as well as $82,000 in accrued interest. So we have an investment portfolio. $260,000 was received. We'll debit cash. We're going to credit the accrued interest that we had on the books of $82,000, so we'll get rid of that receivable, and we will credit interest income for the remainder. Okay, number 4, basically the expenses, and just list out all the expenses accrued for the year. All right, so we didn't pay them yet, we're just accruing for them, so we're debiting the various expense accounts and we're crediting accounts payable. Number 5, cash receipts for customer deposits. So we have new customers coming online, 2,427. New customers coming online, they're paying cash deposits. Take a look at the journal entry real closely. Instead of debiting the regular operating cash account, we're debiting the restricted cash account. We have to be careful with that. We have 2 cash line items on the balance sheet. And then we will credit the liability called customer deposits. All right, number 6, cash collections. So we're basically collecting on our receivables. The majority of it is coming from the external customers, like you and I that live within the community, and $209,000 and change from the general fund. So we're going to debit cash for the full amount, and we will credit the receivables, credit the generic accounts receivable, and we will credit due from general fund, the other receivable. All right, number 7. We made a whole bunch of cash payments. We paid off our accounts payable, $1,462,000. We paid some interest. Which includes a previous interest payable of $395,000. We paid principal on a bond of $400,000, and we bought a machinery and equipment, $583,000, and we returned customer deposits. They must have ended their account and they left in good standing, so they got their customer deposit back of $912. And so what you're going to see here in this journal entry is, well, here's the accounts payable we're paying with a debit. Here's the interest we're paying. Some of it was interest payable. That was accrued previously before the year started. The rest is an expense. We're paying down some debt, so we'll debit the current portion of the debt. We bought a machinery and equipment, so we'll debit that asset. And we're returning the customer deposit, so we will debit the liability. We're going to credit, all of it is a credit to cash. The majority of it is a credit to the operating cash, but remember, the customer deposit is going to come out of the restricted cash account. 2 separate accounts that we need to pay attention to. Okay, next, number 8. A state grant amounting to $475,000 was received to help pay for new water treatment equipment. So $475,000 grant revenue comes in. We're going to debit cash, and the credit goes to a contribution account. It's not revenue. It's like revenue, but it's a separate category called contributions. I am going to show you that when we go through the financial statements at the end of these transactions. I'll show you where it's actually reported. Okay, number 9. We are writing off some accounts receivable. $10,013. So the journal entry, as you've learned in your other accounting classes, we will debit the contra receivable, the allowance for doubtful accounts, or in this case, we call it the accumulated provision for uncollectible accounts. And we're going to write off the receivable with a credit. Now, in addition, just as a sidebar here, in addition to recording this journal entry, the government also flips the switch. So when that person comes home, guess what? There's not going to be any water coming through their shower heads or their faucets. They're not going to be happy. You never skip your water bill. That's a big mistake. Number 10, the utility fund transferred $800,000 in excess income to the general fund. So actually the word was used in the description. We transferred money out. So one thing you have to understand here is proprietary funds don't use the account names called other financing sources and other financing uses. We're simply going to call it a transfer in or a transfer out. In this case, it's a transfer out, which is like another financing use. It will be debited, and we will reduce cash with a credit. Journal entry 11 is really multiple journal entries in one. These are basically the adjusting entries at the end of the period for financial statement financial statement preparation. We got to go through these adjusting entries for accrual accounting. And so what do we have here? We have depreciation on buildings, depreciation on equipment. We are increasing our allowance for doubtful accounts. We're going to accrue for water usage for customers that haven't been billed yet. We're going to accrue for interest income and accrue for interest expense. Lots of journal entries here. This is multiple journal entries in one. But taking them one by one, this is what it looks like. First, the depreciation expense, debit, and we're going to credit the accumulated depreciation accounts. The allowance for doubtful accounts is being increased, so we will debit bad debt expense, and we will credit the accumulated provision or the allowance for doubtful accounts. We're going to accrue for interest, so we'll debit interest expense, credit interest payable. We're going to accrue for water usage that our customers use, but they weren't billed yet. So we will debit this asset called accrued utility revenue and credit the water sales. And lastly, we will accrue for interest income, debit interest receivable and credit interest income. And the last journal entry of the year before the closing entries is the bond payable account was adjusted by $400,000 to record the current portion of the bond. So basically what's going on here is, if you remember, well, let me refresh your memory. If you come back up here in journal entry 7, do you remember we made a $400,000 principal payment on the bond? And we did so because we debited we made a $400,000 payment on the debt. So we debited the current portion of the long-term debt. And so because we paid the current portion, what's happening in journal entry 12 is the next $400,000 principal payment is graduating. All right, so we're going to graduate the next $400,000 in the current, and we will debit the long-term liability. All right, so now the closing entries. We'll close our revenue accounts, and we have 3 of them. Water sales, interest income, and the grant contribution. Close them out with debits. And we will close all of our expenses with credits. The difference, whatever is needed, is going to get closed out to unrestricted net position. And so there it is. We have a net income of $366,000, which we will close out. And then after we close out the unrestricted net position, we will then update our restricted and our net investment in capital assets. Well, from what I saw in these 12 journal entries, I didn't see anything that was restricted, but that affected equity. But what I did see is that there were some transactions that affected net investment in capital assets. And there's really 3 of them. Well, this machinery and equipment increases net investment in capital assets. So does this $400,000 payment. Okay? The $400,000 payment reduces the liability associated with the fixed asset. So therefore it increases your net investment in capital assets. So these 2 total increase your net investment in capital assets. And then your $600,000 in depreciation expense reduces your net investment in capital assets. All told, your net investment in capital assets increases a net of $383,293. And here is your operating statement. I just wanted to show you where everything is reported. On the top, we have our sales less our expenses, gives us operating income. And then we show our non-operating expenses and revenue. We have interest income less interest expense. And then we have a subtotal called income before transfers and contributions. And that's where we're going to show the transfers out. And if we had transfers in, we'd show it here too. And then, of course, we have our capital contributions. This is the grant money that came in. Just wanted to show you that. Okay, so once again, just like an internal service fund, the enterprise fund uses accrual accounting. There's a couple of more nuances to it, like the customer deposits and the restricted cash and the accrued utility revenue. But besides that, normal accrual accounting. Usually students really like this chapter. There's not a lot of depth to it because a lot of this comes naturally to you with the prerequisite knowledge.